All right, good day, everyone. Welcome to my YouTube channel at Illumination of NG. Kindly click on the notification bell and also subscribe to my YouTube channel at Illumination of NG, and kindly share my videos with your friends, your colleagues, your classmates. So today we are going to be looking at IAS-2, which is an accounting standard on inventory developed by the International Accounting Standards Board, previously known as the International Accounting Standards Committee, in 1993, when the standard was known as valuation and presentation of inventories in the context of the historical cost system, okay? Though it was issued in 1975. And in December of 2003, the board now revised this standard to comply or meet up with current standard in business, okay? So the revised standard further explore the various definitions of inventory and also develop new formulas, okay, for decision-making processes or purposes when it comes to having to recognize inventory in the income statement. Okay, so what is inventory? What is inventory? Let us go down to the definition of inventory according to IAS-2. Now, inventory definition is in three steps, okay, or phases. What I mean is that the IAS-2 defines inventory in three forms, okay? First one is that inventories are, you should know that inventories are assets, okay? They are assets. Inventories are assets. Inventories are assets, okay? And we know that assets are items owned by the organization from which the organization expects economic benefit, okay, in future years, okay? So from that asset being acquired, okay? So inventory, according to IAS-2, is simply assets that are what? That are held for sale. Assets that are held for sale. And these assets held for sale are in the form of finished goods or stock in trade. Now I'm going to explain that to you before we move on to the next point, or that's the next definition on inventory, okay? So when we talk about some business sectors like the real estate, okay? Like the real estate business, we know that buildings, okay? Buildings are assets, okay? And these assets are what? They are what we call non-current assets, okay? But in the case of real estate, these assets are held. They are being held for sale. That is, those real estate companies that build properties, they build properties and further sell them to be sold, okay? To be sold. So in this case, those assets are regarded to as stock, dead to as stock, okay? So there is stock in trade, okay, for such businesses. So these assets are what? They are held for sale, okay? Now, the second definition is assets that are what? That are still undergoing production process, okay? So when we talk about assets that are being converted, we're talking about, or assets that are still undergoing production processes, we're talking about conversion, okay? Conversion of assets, which is synonymous or similar with the manufacturing entities, okay? Manufacturing entities. These entities are organizations that are responsible for the conversion of raw materials that are what? That are gathered from where? From the primary sector, which are further what? Converted or processed into finished goods. For what? For the use of the final consumers. Like we know in economics, we talk about the chain of distribution, okay? Talk about the chain of distribution, okay? From the producer, which is the manufacturer, to the wholesaler, down to the retailer, and finally to what? To the final consumer. Okay, the producer produces this item, which is what? Converted. It goes what? Through conversion processes and finally creates what we call utility to what? To the final consumer. In this case, such assets that are what? That are still undergoing work in progress. They have not finished converting them. Assets being converted, they are what? They are regarded to as what? Inventories. Okay, so let us have that at the back of our mind. Okay, those are inventories. Now the third one is inventories are what? Are assets that are what? That are in the form of material or supplies that are required for further production processing to finished goods. These are what? Raw materials. You know that raw materials to the agricultural sector, agri sector, okay, are known as inventories. So in this case, we have items of inventory as work in progress, okay, finished goods, and raw material. Please kindly take note, okay? So let us move on to the next subtopic, which is what? Disclosure requirements for inventory. Now, what are those things that we are required to disclose in the accounts when recognizing inventory? Okay, now according to IAS-2, we are required to state the accounting policy used in measuring the inventories, okay, including the cost measurement method adopted. Now, when we talk about the cost measurement method adopted, we should know that under IAS-2, IAS-2 recognizes in valuation of or costing of inventory, okay, or stock. IAS-2 recognizes first in, first out method, okay, and weighted average method. This is known as FIFO, and this is known as WAM, okay, WAM. Please take note. So these two methods of costing or valuation of cost are recognized according to what? IAS-2. But last in, first out is what? Ignored. Last in, first out method of inventory valuation is ignored. Okay, so take note, this is what? Ignored, okay? So let us move on to the next one. According to IAS-2, you are required to disclose the total carrying value of the inventories with proper classification, e.g., to a manufacturer. Inventories are classified as finished goods, work in progress, or raw materials. And for a retailer, it is referred to as stock in trade, okay? So we should take note of this. The third one, the amount of inventory carried as net realizable value, or this is net realizable value, which is what is known as what? Sales less cost to sale. It can also be what? Fair value. It can also be fair value less cost to sale. So this is how we arrive at what our NRV. So you have to know how to determine, and you have to disclose how you arrive at your NRV, which is what? Your net realizable value. And also the standard says that the value of inventories that were written down are recognized as expenses during the financial period. Now, we know that before you acquire an inventory, you must undergo some expenses, okay? You know that based on our double entry principle knowledge, okay, when you acquire stock, okay, what do? You debit your assets, okay, and what? And either what? You credit cash or bank, okay? Which means if you are paying cash or bank, you what? You credit, okay? Sorry for that. You credit cash, okay? And in case of expenses, you're going to what? You're going to debit expenses in the ledger account, okay? or in your income statement. Okay, so this is how you're going to recognize your stock. So any item of expenses that are what, that led to what, you writing down the value. When we say writing down, that is, we are reducing the value, okay, of that asset, okay, which is an expense. You have to what, you have to what, require, you have to recognize this in the financial period on your account, in the notes. Okay. So the next one is that is you are what's required to provide details. You're required to provide details of any circumstances that led to that write down of inventories to net realizable value. And the next one is that what, the value of any reversal of any write down that is recognized as a reduction in the value of inventories, recognized as expense during the period, and also the circumstances or events that led to what, to the reversal of what, of a write down of inventory. So let us move on because we don't have that time. So in the next video we're going to do some workings, but let us quickly do some explanation so that you have an idea of what IAS-2 is all about. So how do we measure? So the measurement rule in IAS-2 states that IAS-2 requires that inventory must be measured in the financial statement as well as the lower of cost, and net realizable value. So what we're saying is that if the cost of the inventory is 10,000 and the NRV calculated is 5,000, okay, so in our income statement, the cost of stock or closing stock to recognize is what, is that the value of what at NRV, because it is what, it is lower compared to what, to the initial cost. Okay, so if the cost is 5,000, okay, and the NRV is 7,000, okay, we're going to what, take this 5,000 and recognize it and reject this 7,000. And please take note and have this at the back of your mind. So the next one is what is cost of inventory. Okay, so we're talking about cost of inventory, that is the stock that we're talking about. Okay, what is the cost of procuring them, okay, at a given market value. So cost of inventory according to IAS-2 are all costs of purchases, okay, the cost of converting that item, as well as other costs incurred bringing the inventory to their current location. These are logistic or transportation or warehousing costs, okay, warehousing cost. So the cost consists of the following. Number one is that you have to the purchase price, okay, the import duties paid on those items, okay, excluding recoverable sales tax, okay, so you have to exclude the recoverable sales tax. Then transportation, handling, and other costs that are directly attributable to the purchase, e.g. carried inwards. Okay, we know that carried inwards is an additional cost on purchases. Okay, you add carried inwards to your purchases, okay, and to your opening stock to get your cost of goods available. That it is always what we're saying. You know, you have your opening stock, okay, you add purchases, okay, add inwards on purchases, okay. So the value, when you add together, you get your cost of goods. So that is COGS, okay. So the last point is that the purchase price excludes any settlement discount, okay. That's settlement discount, unlike trade discount, okay, and it is seen as a cost incurred after the deduction of, we can see that after deduction of the trade discount, okay. So what we are saying that the only recognizable cost under IAS-2 is what, is to recognize the trade discount, and any other settlement discounts must not be recognized. Okay, what we're saying is that if you have a sales of 10,000, okay, and you are given a discount of 5% on these sales, then it means that what, that will be 5% of 10,000, okay, you give us that will be 500, okay. So at the end of the day, the sales will be 10,000 minus 500, which is 99,500, which is what we're going to be recognizing in the case of a trade discount, okay. So, but anything that has to do with settlement, other settlement discounts, we are not going to recognize them because they are not relevant, okay, to the cost of the inventory. So thank you very much for your time, and thank you for